Good afternoon and welcome to Charting Points, a technical look at ag markets. Today is November 14th, 2023, and this is actually the second time we're running through this because the first time I forgot to put my mic off of mute, which meant the whole presentation was just charts and me drawing on charts without you actually hearing what I was saying. So hopefully we've corrected the problem. We'll get going into the charting points for today, but first, the disclaimer: trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future results. All right, we're going to talk about canola today. We're going to talk about recommendations on canola today and the risks and rewards of doing that. So here is the canola chart after the trade today. As you can see, we saw a big jump up in the market today. I'm going to turn on my trusty red pen because I like drawing on things. We saw some nice technical signals. Late last week, we saw a close above the 20-day moving average. Yesterday, the canola market was closed, but we did some catch up after the surge in soybean prices on Monday in the US, and it actually moved higher above about to 721.90, I think was the high of the market today. Our target to make our next recommendation was when we kind of got into the range of this previous high and this 38.2% Fibonacci retracement level. There is also a 50-day moving average here. Those three areas are a place where I would like to add some coverage into this market. That was 725 to 730 was my target range. Again, we got to 721.90 today, so we just got shy of that. Part of me wants to make a recommendation today anyway, but I'm going to hold off, and I'll explain on that a little bit in the coming slides. But I still do think that it is appropriate to make a recommendation here as we move towards 730, as we get to all of those resistance levels. Now, this is particularly important, I think, if you may be one of those folks who are undersold versus our recommendations. We're at 50% now. We're going to look to move to about 60% on the next recommendation at about 725 to 730. So use that opportunity to get caught up. For those of you who also have access to over-the-counter risk management strategies or over-the-counter risk management strategies or even brokerage strategies, when we do issue the recommendation, we'll talk about some ideas that you may want to execute on as far as risk management goes. Our next target area for sales recommendations will be in this 760 to 770 area. That is the 61.8% retracement on the Fibonacci. Again, that kind of lines up here with this cluster movement higher and even this 100-day moving average here as well. So that's kind of our stepped up approach here is 730 for the next one, 725 to 730, 760 to 770 for the one after that. Now, why would I not be fully bullish on canola here? I think that there is a lot of risk factors in canola. Number one, I think that Stats Canada at the early December is going to give us an update on canola tonnage produced. I think it's going to be possibly higher than what we all are expecting. And, even the USDA is currently projecting 400,000 tons more than what Stats Canada is printing right now. So I think there's a very high possibility that we will see higher production rates. We're also still seeing some weakness in some of the other markets. Some of them are turning over, but it's not a guarantee yet that they're changing from bearish to full-blown bullish. So as a result, we want to be a little bit cautious and continue to take the disciplined and stepped approach. I do understand that crush plants are not having a lot of trouble sourcing product, and they're not looking for a lot of product in the short term. That may change as we move through the crop year, but we want to also recognize that adding coverage now does not make us completely absolved of any upside potential going into the future either. So we'll talk about risk management strategies when we make the recommendation, but in this case, that is the areas that we're going to be targeting now for canola. All right, moving on to some of the other inputs that are affecting canola. Here's December soybean oil. We did see trade today move above the 20-day moving average, and it did briefly make a new high here in this market. This is a positive sign. Momentum is still kind of trending lower here, as you can tell by this 50-day moving average crossing these longer-term moving averages. So there might be some resistance as we get kind of towards that 55 cents a pound area on the D soybean oil. We're not far from that now. This market is ripe for a bit of a pullback here. And that might be a place where it might consolidate or maybe even be a pivot point. Again, another reason why we didn't necessarily make the canola recommendation today. We think that there could possibly be higher. For sure, I think we want to leave ourselves the opportunity to get up into that 725, 730 area. Malaysian palm oil also had a good day. It made a new high in Monday's session or the overnight session, and again in today's session as well, popping up to 39.41. We're a stone's throw away from 4,000. This is Malaysian ringgit. And we have some resistance up here as well at 4,100. So overall, this is a bit of a bearish or a bit of a bullish chart. It pulls out of the sideways pattern that we've been seeing in palm oil and kind of catapults it above some of those levels now. So there may be some momentum that tracks inside of that market as well. Here's kind of what canola has been doing on, this is China, Chinese prices of veg oils. We've been talking about the spread between canola oil and the other oils coming together, closer together. We're starting to see that happen now. Through the months of September and October, it still looked pretty wide as far as the spread between canola oil and soybean oil. Through the last half of October, we saw soybean oil come up a bit and canola oil decline. I believe now that spread is in an appropriate range where we will start seeing a pretty high correlation between soybean oil and canola oil in China. We're also seeing palm oil trade near the top of its recent ranges here through October and November as well. So it might be coming out of the doldrums there as well. Now, kind of looking at what happened with soybeans today. Now, soybeans are a little bit separate from the others, but I still think it's worth talking about. Soybeans traded closed at 13.89 today. That's the highest close that we've seen in a number of weeks or a number of months, actually. This, of course, is predicated on a Brazilian weather story that it continues to be hot and dry through much of the week. There is some rain that has been forecasted into the early parts of next week. But again, I think the market is discounting the further out weather patterns in favor of the closer weather patterns. There's also some pretty scary imagery and stuff coming out of Brazil with some pretty, poor looking crops, dried up fields, all of those kinds of things. So there's still some risk premium being placed into Brazil. Now, Brazil is still forecasted to have one of the highest production on record. But again, I think that number is starting to get peeled back by the market. And whenever you're starting to peel back, even if it is record high, you tend to see some support come into the market. So this is a positive here in the soybeans. We have the 20-day crossing some of these moving averages here. We're producing higher lows and higher highs in this market, and today made a new high here as well. So this market is, or continues to look bullish. The soybean meal market is also continuing to look bullish. Now today, this is a wild ride if you're a soy meal trader. We traded higher early on in the day, and then it looked like turnaround Tuesday and that the market was going to come back down and pull a reversal. But there was a reversal during the day as well, and it came back up and closed near those highs at 473. This is the highest close. As you can see, these last 2 days broke well above this previous cluster of closes, opens and closes at the end of October, beginning of November. We're kind of in new territory now. So this chart continues to look well supported and bullish as well. Now, looking at the December Minneapolis wheat, today, the spring wheat, this is the only wheat chart I'm going to talk about today because the other two were a little bit lower and relatively muted, but I did like what I saw here out of the Minneapolis wheat. I do think it gives us an opportunity to add some coverage as well, and there is a basis component to this as well, which I'll talk about in a second. But we are kind of coming up to this resistance level here of the 50-day moving average and some of these previous lows here. Not sure which one is more important, the one at 757 or down here at 745-ish. But somewhere in this range, I think there's an opportunity to get some Minneapolis wheat priced. on the future side. So just going to keep an eye out for that as well. This may be a little bit lagged compared to our canola recommendation, but I'd like to add some coverage here in Minneapolis wheat. I do feel that our position on Minneapolis wheat is a little bit shorter than what I would like it to be at this point. So now I'm going to talk a little bit about how that how the basis plays into that. And to start off that conversation, I want to talk a little bit about U.S. inflation and what it did to the market today. So the inflation rate was announced today at 3.2%. The market was expecting 3.3%. So lower than expected. I think the market is reacting in a relatively, in a pretty outsized fashion at this point. This is the US dollar index today. It's sunk considerably right down to new lows and right down to this 100-day moving average here. A very large move in the US dollar. This was not only in the US dollar. However, we did see 10-year note yields lower as well. And we saw the S&P 500 futures rally significantly. So what does this tell us? It tells us that the market is now pricing in the possibility of interest rate cuts. Now, I did go look at the probability, the Fed probability chart before starting this presentation. And last week, it looked like there was a high probability of a stay on rates in the next meeting in December with a slight bias towards higher rates. Today, that has flipped a little bit. There's still a very high probability, 99% right now, of a stay on rates in December, but the market is now pricing in a cut in some future meetings, down 0.25 percentage point. So the sentiment of the market has flipped, and that's why you're seeing some of these markets do what they're doing here. This like the yields, the dollar index, and the stock market. So what does that mean to the Canadian dollar? Now, we did see a pretty big rise in the Canadian dollar today, traded back up towards 73 cents. Really strong move. Didn't best that move that we saw earlier in November. But I think that what is happening here is we're starting to see this market produce some higher lows. And so if this move moves to a higher high, that could start making this Canadian dollar market look quite friendly, and at least friendly to the Canadian dollar. What that means, however, though, is that it might start putting some pressure on some of the Canadian commodities. What I'm thinking about particularly here is basis on Minneapolis wheat. So we may be getting to a point here where the Canadian dollar is starting to look bullish, which might pull some value out of the basis, and we might start getting to a point where the Minneapolis futures are getting to some resistance where we want to pull some risk off the table there as well. So just to kind of give you some context around that. That's actually the last slide I have for you today. Have a great day, and we will see you again on Thursday.